Hey everyone, welcome back to Wise Elephant. If you look at your bank account at the end of the year and wonder where the money went, the answer usually is not Starbucks or Netflix. For most of us, the single biggest expense we will ever have in our entire lives is tax. If you live in the US, you will likely pay more in taxes over your lifetime than you will on food, housing, or travel. But most people see taxes as a fixed bill, like a fine you have to pay for the crime of earning money. In reality, the tax code is more like a manual for a game. The government wants you to invest in your retirement, buy a house, and start a business. So they have built in some cheats to encourage that. So treat your taxes like a game, and if you know the right rules, you can legally and ethically save thousands of dollars. Today, I'm breaking down 12 strategies or tips to help you reduce your taxable income and keep more of what you earn. We are going from the absolute basics to some advanced high earner moves. So let's get into it. Tip number 1, the threshold strategy. First, we need to understand how taxing works. Most people think if they get a raise and move into the 32% bracket, all their money is now taxed at 32%. That is 100% false. In the US, we have marginal tax brackets. Your first $16,000, if you're single, is basically free due to the standard deduction. If you're married and filing jointly, you can deduct $32,200 outright as standard deduction. The next chunk is 10%, then 12%, and so on. Only the last dollars that you earn or hit with that high rate. So our goal isn't just to save the money, it's to reduce our taxable income. We want to take those top dollars, the ones that are sitting in the 24% or 32% buckets, and shove them into accounts where the IRS cannot see them. If we can lower our taxable income enough, we can effectively drop ourselves into a lower bracket entirely. So that is the threshold strategy. Tip 2, maxing the 401k and 403b. Tip number 2 is a classic and the most basic move, the employer retirement plan. For 2026, the contribution limit has been adjusted for inflation to $24,500. If you are above 50 years of age, you are allowed to make additional contributions to the retirement accounts called catch-up limits. If you are in the 24% tax bracket, putting the full amount of $24,500 in saves you $5,880 in taxes immediately. If you are a high earner in the 32% bracket, putting that full amount into the retirement account in reduces your tax bill by nearly $7,800 immediately. It's a guaranteed return on your investment. So if your company offers a match, that is literally free money on top of a tax discount. So do not leave it on the table. For the 2026 tax year, you can indeed contribute to both a workplace plan like a 401k or 403b and an individual retirement account, also called IRA. The 2026 limit for an IRA is $7,500 plus a $1,100 additional catch-up if you are 50 plus. However, whether that $7,500 is tax deductible depends on your income and whether you or your spouse have a retirement plan at work. So let's look at traditional IRA deduction limits for 2026. If you are covered by 401k or 403b at work, your ability to deduct your traditional IRA contribution phases out based on your modified adjusted gross income. So check out the limits here. If you are not covered by a plan at work but your spouse is, the phase out for your deduction is much higher, $242,000 to $252,000. Roth IRA contribution limits for 2026. Roth IRAs never give you a tax deduction today, but the money grows and comes out tax-free later. You can only contribute if your income is below these limits. Here are the limits based on your filing status and household income. You can take a quick look. Tip number 3, the backdoor Roth IRA if you are over the limits. If your income is too high to deduct a traditional IRA contribution and too high to contribute to a Roth IRA, you can still get money into the tax advantaged account using this trick. So you contribute $7,500 into traditional IRA, which has no income limit for contributions. You don't take a tax deduction. Then you convert that money immediately into a Roth IRA. Because there was no deduction, there is no tax on the conversion, assuming you have no other traditional IRA funds. Now that money grows tax-free forever. It's a legal loophole that every high earner should be using. If you're under 50 and meet the income requirements, your total retirement bucket for 2026 should look like this. $24,500 in a 401k or 403b plan, $7,500 in traditional or Roth IRA, total coming to $32,000 per person in the tax advantage space. Tip 4. The Mega Backdoor Roth. This is the pro version. If the regular backdoor is a loophole, this is the highway. Some 401k plans allow for after-tax contributions. If your employer does allow this, you can contribute up to a total of $72,000 between your employee deferral, employer match, and after-tax cash. You then move that after-tax money into a Roth 401k or Roth IRA. It's the single most powerful way to build a multi-million-dollar tax-free nest egg. So check with your HR department. Ask if they allow after-tax contributions and in-service distributions. Tip number 5. The God tier account HSA. If I could only keep one account, it would be the HSA, Health Savings Account. It is triple tax advantaged. For 2026, you can put in $4,400 individual or $8,750 for a family. Money goes in pre-tax, lowers your income, it grows tax-free, it comes out tax-free for medical expenses. The pro move. Don't spend the HSA money. Pay for your doctor visits out of pocket, scan the receipts and save them in a folder. Let the HSA money stay invested in the S&P 500 or any other ETF for 20 years. In 2046, you can reimburse yourself for those 2026 receipts tax-free. It's the ultimate stealth retirement fund. Tip 6. Use it or lose it FSAs. Then we have FSAs or flexible spending accounts. These are different from the HSA accounts. The healthcare FSA with limit of $3,400 and the dependent care FSA with a limit of $7,500 for 2026. Some employers may allow additional grace period to spend the FSA funds or allow some FSA funds to roll over to next year. You can use them to pay for medical, dental or vision expenses. The dependent care FSA is a huge for parents. If you're paying for daycare or preschool, that's $7,500 of income you're not paying tax on. However, be careful. FSAs are use it or lose it. If you don't spend it by the end of the year, the money goes back to your employer. It's a great tool, but you have to be precise with your math. Let me also call out on the highly compensated employees here. Note that if you earned over $160,000 in 2025, your employer may restrict your contribution to a lower amount, often around $3,200, to pass IRS non-discrimination testing. This is for the dependent care FSA. Tip 7. The 529 plan. State tax hack. Next is the 529 education plan. There is no federal deduction here, but over 30 states offer a state tax deduction or credit. Federal gifting limits. Technically, you can contribute as much as you want to a 529 account. But to avoid filing a gift tax return or using up your lifetime exemption, most people stay within these bounds. Individual limit $19,000 per beneficiary. Married couples $38,000 per beneficiary. Super funding or 5-year election. 529 plans allow you to front load 5 years of gifts at once. For individual super fund, you can do $95,000, and for married couple super fund, you can do $190,000 upfront. So the rule is that if you do this in 2026, you generally cannot give any other gifts to that same person until 2031 without triggering a gift tax return filing. State aggregate limits lifetime. Each state sets a total maximum balance per beneficiary. Once an account reaches this limit, no more contributions are allowed, though the account can continue to grow. So the typical range for this is between $235,000 to over $600,000. The highest is in New Hampshire for $621,000 and the lowest is in Georgia for $235,000. So even if your state does not allow tax deduction for these 529 plans, the growth in those accounts is tax-free. And as of 2026, the rules are even more flexible. If your child does not go to college, you can roll up to $35,000 of it into their Roth IRA over time. It's a way to fund your kids' education and their retirement simultaneously. Also, one more tip. If you have leftover funds from one child, you can simply rename the account for a younger sibling or even a cousin. You can change the beneficiary to a wide range of family members, and you can also use the funds for your own education. Tip 8. Primary home. If you own your primary home, the government is basically giving you a discount on your living expenses. First, you can write off all the interest you pay on a mortgage up to $750,000. Second, if you put less than 20% down, you're likely paying a PMI. And for 2026, that is officially tax deductible again. You can also deduct discount points you paid at closing to lower your rate. Also, if you're using a HELOC or home equity line of credit to fix up the kitchen or add a deck, that interest is deductible too. Under the One Big Beautiful Bill, the cap on property tax deductions jumped from $10,000 all the way to $40,400. That is massive for anyone in high tax states. Just remember, these only work if you itemize your taxes instead of taking the standard deduction. So keep those receipts. The capital gains shield. While not a yearly deduction, also remember that the $500,000 exclusion. If you sell your primary home in 2026, the first $500,000 in profit for married couples is 100% tax-free, provided you lived in it for 2 of the last 5 years. Tip 9. Rental property and depreciation. If you own a rental property, you have a superpower called depreciation. The IRS assumes your building is wearing out over 27.5 years. So even if the property is actually increasing in value, you get to take a paper loss every year. This loss can often cancel out all the rent you collect, meaning you get the cash flow, but on paper, you made $0. Pro tip: minimal rental rule. If you rent your primary home or a vacation home for 14 days or less in a calendar year, that income is 100% tax-free. You don't even have to report it. Imagine if you live near a major stadium or a festival. You rent out your house for $1,000 a night during a 10-day event. You just pocketed $10,000 on your tax return. It's like that money never existed. Or if you're a business owner, host your quarterly strategy meetings at your house instead of a hotel. Pay yourself the venue fee and take the deduction in your business and keep the cash personally without paying the IRS a dime. Tip 10. Tax loss harvesting. Tip 10 is about your brokerage account. If you have stocks that have lost value, you can sell them to realize the loss, a move called tax loss harvesting. You can use these losses to cancel out any capital gains you made from selling winners, so you don't pay taxes on the profit. If your losses are bigger than your gains, you can even use up to $3,000 of that loss to lower your regular taxable income like your salary. But here is the rule. Don't sell a loser just for the tax bill. Only do this if you are planning to sell anyway to rebalance your portfolio. If you sell just to grab the tax loss and then buy the exact same stock back within 30 days, the IRS will trigger the wash sale rule and cancel your deduction entirely. If you want to stay in the market, buy a similar but not identical ETF instead. And tip 11, optimizing RSUs. RSUs are restricted stock units. Tip 11 is for anyone getting restricted stock units or RSUs. A common mistake is thinking you have to hold for a year to get lower taxes. That is a myth. The second your RSUs vest, they are taxed as ordinary income based on the current stock price, exactly like a cash bonus. There is zero special tax benefit to holding the stock after vesting. If you hold them and the stock goes up, you will owe extra capital gains tax on that growth. And if the stock goes down, you have still paid income tax on the higher original value. So the pro move is to sell 100% of your shares the moment they vest. Since you already paid the income tax at vest, selling immediately means you owe zero capital gains tax. You can then take that cash and move it into a diversified index fund, which is much safer than having your job and your life savings tied to one single company. If your boss offered you a $10,000 cash bonus today, would you immediately take that cash and buy more of your company's stock? If the answer is no, then you shouldn't be holding your RSUs either. Sell them, take the win, and diversify. Tip 12, business and commuter benefits. For business owners, the ordinary and necessary rule is the ultimate tool for turning a life of travel and growth into a tax shield. You can deduct 100% of flights and hotels for workcations as long as the primary purpose of the trip is business. And you can even deduct your own professional coaching, workshops, and masterminds to let the IRS fund your self-improvement. Additionally, you can claim a record high 72.5 cents per mile for every business-related trip in your personal car. And in some cases, you can even write off pet-related expenses if your animal serves as a legitimate business role like a studio guard dog. And for content creators can essentially write off their lifestyle because their daily life is their product. This means that high-end phones, laptops, cameras, high-speed internet are 100% deductible production tools. And if you have a dedicated studio space, the home office deduction lets you write off a portion of your actual rent and utilities. For those in specific niches, expenses like gym memberships and supplements for fitness creators or travel costs for vloggers are considered necessary business inventory, allowing you to build your brand while significantly lowering your taxable income. And for W-2 employees, if you're still paying for your daily commute with after-tax cash, you're essentially giving the government a tip for your ride to work. Commuting benefits got a major boost for 2026. Employees can now set aside up to $340 per month for transit passes, trains, buses, and even van pools. And they can deduct another $340 per month for parking separately. This means if you take a train and then pay for parking at the station, you could potentially shield over $8,100 a year from taxes. Plus, bicycle commuter benefits are officially back on the table as a tax-free reimbursement for 2026. Most importantly, the new law allows eligible workers to deduct up to $12,500 of overtime pay and $25,000 in tips from their taxable income, making your extra hustle at work significantly more profitable. Remember, you don't need to be a giant corporation to do this. Whether you're a freelancer, content creator, or a side hustler, if an expense helps you make money, it's a legal write-off. Now, a special bonus tip for you: the Trump account. The 2026 tax rules just made it way easier to save for your kids. With the new Trump accounts, every child born between 2025 and 2028 is eligible for a $1,000 government deposit to jumpstart their savings. You just file Form 4547 to get started. The best part, your employer can match your contributions up to $2,500 and you don't pay a dime in taxes on that match. You can add up to $5,000 a year in total, and the money grows in safe, low-cost index funds until they turn 18. Once they are adults, it turns into a regular IRA they can use for a house down payment or college. It's one of the best set-it-and-forget-it ways to turn your kid into a millionaire by retirement. So those are the 12 ways to win the tax game. It's not about being a tax dodger, it's about using the incentives the government created to encourage us to save, invest, and grow. Tax planning isn't something you do once a year in April. It's a series of small intentional decisions you make every month. If you have not already, please consider subscribing to Wise Elephant and click on the bell icon to not miss any of my future video updates. Thanks for watching, stay curious, and I'll see you in the next one.